Hi to IPO subscribers. Welcome to eaglelive.ai. Today let us review IPO from ESDS Software Solutions Limited. Here we go on IPO review. This is the financial analysis of the company as generated by AI for software. Based on the metrics given to the software, this company has been categorized as an unhealthy company. Let us see the financial analysis. And coming to health analysis, solvency, as you know, solvency ensures the sustainability of the company. Here everything is okay. Debt to assets ratio, it should be 0.66, but debt is high, 0.71. Coming to net worth to assets ratio, it should be 0.34. It is a net worth, but it's 0.8. This is the reason why this company has been categorized as a unhealthy company. So that means solvency is not strong. So coming to a liquidity is also current ratio should be 1.33, 1.16. What does it mean? The company has not brought in their full amount of working capital margin money. So coming to operational efficiency and everything is okay. Only thing is receivable turnover and trade payable are negative and financial irregularities not identified. Very good. Profitability and EBITDA 242.68, EBIT is 179.21, and PBT is 167.42, PAT is 122.68, and cash profit is 186.14, EPS is 12.03, EBITDA margin is 50.48, good, net profit margin 25.59, very good, ROC is 32.78, very good, ROE is 25.12, this is also okay, good. So coming to book value, 54.13. So this cash flow from operating activity is 1,367.71. So coming to cash flow from the net cash flow, so net cash flow is 1,191.83 positive. So this is okay. Market value, market price is 429. It appears to be rate is very high, and based on that, price earning ratio is coming to 35.6, aggressive, overvalued, I should say. So market price was cap price is overvalued. Price to book value is 7.92. It is also abnormal, aggressive, I should say. So not in favor of the investors. And growth indicators are positive. So this is the financial analysis of the fund. Fundamental analysis of the company. Now let us go on IPO review. This is the IPO review of the company. Strong AI and cloud story, but is the valuation too expensive? Let us see. Opening, ESDS Software Solutions is entering the IPO market with a strong AI, cloud and data center growth story. But investors are paying around 36 times earnings and over 8 times book value. Abnormal, I should say. So the real question is a future growth already price rate? Yes, of course. Let us analyze ESDS from a business, financial, health, and valuation perspectives. And business overview, AI-enabled cloud and data center infrastructure company. And provides infrastructure. Rest is, I don't know how to spell it. Provides managed cloud and IT services. Offers software, of course. Provide GPU for AI workloads and cyber security backup, disaster recovery and DevOps solution. Proprietary Swaraj Cloud Technology serves BFSI, government and enterprise customers. Served approximately 2,500 plus customers in financial year 2026. Operates in 5 tier 3 data centers across India. Business takeaway, ESDS is positioned at the intersection of the 3 high growth trends, AI plus cloud computing plus data center. Why the market is interested? Strong industry tailwinds, rapid adoption of artificial intelligence, increasing demand for computing and GPU capacity, growing cloud adoption and by enterprises, data localization requirements, increasing cybersecurity needs, government support for India's AI ecosystem, and expansion of data center infrastructure beyond traditional metros. Investor perspective, the industry opportunity is definitely attractive. Okay, but a good industry does not automatically make every IPO a good investment. Yes, 100% correct. IPO money, where it is going? So let us see 720 crores fresh issue. The IPO is entirely a fresh issue with no offer per se. Very good. Approximately 576 crores cloud computing and data center. 148 crores they are left for general corporate expenditure. It is at a higher side. The remaining amount is intended for general corporate purpose. And what is positive? A substantial portion of the IPO plus proceeds is being invested directly into the core business. Very good. The company is essentially raising capital to expand its infrastructure and capacity. Good. Money is going to the business. Financial performance. FY 2026 snapshot. Revenue 472.21 crore. PAT 120.82 crore. The company reported strong improvement in FY 2026 with the revenue increasing about 28% and PAT increasing about 170% year on year. Okay, good. Positive. Profit growth is significantly faster than revenue growth, but the investor should ask, can this level of profit growth continues after the IPO? Because the valuation assumes substantial future growth. Valuation, the biggest concern. IPO price band 408 to 429. At the upper price band, EPS is 11.81, PE is 36.3, and PB is 8.1. The company's implied market capitalization at the upper price band is approximately 5,028 crores. Valuation metric 36 PE is not cheap, and PB 8 book value even is more aggressive. Even assuming strong future growth, the valuation remains demanding. That means the company is not giving any future earnings to the investors. You have to wait for much period, and there is no guarantee. In general, company management should give some future earnings to the investor by fixing the cap price in such a way. So the reported FY 2026 PE at the upper band is 36.3 compared with approximately 20.48 for the Nifty 50 as of August 2026. The key investor question is, are investors paying today for tomorrow's growth? Of course. Yes, a significant amount of future growth appears to be already reflected in the IPO valuation. Financial health unhealthy. Despite strong 5-year 2020 profitability, investors should monitor receivables outstanding beyond 2 months, bad debts, loss allowance of approximately 34.58 crores. Subsidy risk. ESDS Cloud FZ LLC had losses in previous years before becoming profitable in 2026. Compliance history, past delays relating to TDS and GST payments required continued monitoring. Capital intensity. Data center expansion requires continuous investment in equipment, EPS, power, infrastructure, technology, cybersecurity. And bottom line, profitability is improving, but financial quality is not completely risk-free. Governance, positive. Experienced promoters and management, meaningful promoter ownership. Fresh issue means IPO process go to the company concerned. Related party business operating in the same sector required. Investor monitoring for potential conflicts of interest. Market sentiment, positive but selective. So the broader Indian IPO market has recently shown strong momentum. In July-August 2026, 18 of 22 IPO listings delivered positive returns. So with the average listing gains reported at around 25%, indicating strong investor appetite for IPOs. At the same time, current IPO demand has been selective, with the investors paying close attention to valuation, growth visibility, profitability, IPO proceeds, listing premium, expectations. ESDS sentiment. ESDS has attracted attention because of its AI, cloud, data center, plus GPU. Story and because the IPO is backed by prominent markets investors. However, markets enthusiasm should not be confused with the attractive valuation. Investor scorecard, business model strong, AI opportunity strong, data center opportunity strong, industry outlook positive, revenue growth positive, profit growth strong, financial health unhealthy, receivables concern, governance, watch, competition, high, PG, expensive, PB, very expensive, margin of safety, low, overall, cautious, of course. Final investor review, what we like, AI and cloud growth, data center expansion, GPU as and services, strong FY 2026 profit growth, 576 crores business capex, entirely fresh issue, and what we don't like. 36 PE, 8 PB, high valuation, receivables, bad debt concern, capital intensive business, competitive industry, governance and related party, monitoring required. Final verdict, business, coach, industry strong, financial health unhealthy, valuation expensive, market sentiment positive, overall IPO view cautious. Closing statement, ESDS software solution has compelling AI, cloud and data center growth story, but at around 36 times the earnings and 8 times book value, investors are paying a premium price for that growth. The business has potential, but the valuation leaves limited margin of safety. Yes. So our view is cautious, subscribe, good business, strong sector, strong growth potential, but valuation is the key concern. So before subscribing, investors should ask one simple question. Is the ESDS future growth strong enough to justify today's expensive valuation? That is the real investment decision. So, as always, investment decision should be based on your own financial goals and risk tolerance. Thank you very much for watching. If you found this analysis useful, please like the video, subscribe to the channel, and stay connected to us for more detailed IPO and stock market research. Thank you very much.